Good day. I'm Mark Woodworth. I'm the president of PKF Hospitality Research here in Atlanta, Georgia. It's a beautiful day in the fall, and I'm joined once again by my good friend Jack Corgel. Jack, welcome back.
Thanks, Mark.
We thought some of the things that are on our mind of late continue to be the comfortable belief that even though there's lots of uncertainty in the marketplace, hotel profits that have been growing very, very nicely are likely to continue to grow, absent some unforeseen, unpredictable type of event. So, Jack, I'm curious, how's the marketplace from an investment valuation perspective? How are they perceiving that outlook, and what are some of the factors that are contributing to their current view?
Well, Mark, as you stated, the profit prospects for hotels are outstanding. All of the RevPAR gains are being realized, and a lot of it's dropping to the bottom line. The curiosity is that with these strong income streams, we're not seeing the kind of rapid pace of increase in property values that one might expect. And if you look at across other property types, hotels are appreciating at a much slower rate than office, industrial, even multifamily, which many people believe is becoming rapidly overbuilt. So it's a bit of a curiosity that with these strong income streams, there aren't bidders lined up for properties, maybe just outside of the big eight market areas, the New Yorks, the Boston, San Franciscos, Los Angeles, and some of the rest.
So what are the factors that are, one of the ways I interpret that is therefore cap rates for hotels aren't going down or changing, at least at a rate that's commensurate with the level of income growth for hotels. And what are some of the factors? Are interest rates? Is there a lot of concern where they might be going? Is it inflation, or what? Again, what are your thoughts on that?
Well, I'll pick up on your interest rate inflation story here for for a moment. Many economists believe that the actions of the Fed, QE infinity, as many people are calling it, will eventually result in interest rate increases largely driven by inflation. In fact, our economic forecasting agent, Moody's Analytics, has put the 10-year Treasury up to about 4.7 5 years from now, and a fairly rapid increase from the current level, about 1.7. So that's a 300 basis point increase. That hasn't materialized yet. We haven't seen that yet, so we can't really use that as an explanation. So there are other things, and I think, as you and I have talked about many times, this uncertainty question continues to be a damper on the prospects for hotel valuation and increases thereof.
But if I remember my hotel valuation 101, and specifically if you're taking a discounted cash flow analysis, if I really believe that there could be a 300 basis point lift in risk-free treasuries over the next 5 plus or minus years, don't I have to reflect that in my terminal cap rate on valuing that investment today? And clearly that's going to cause me to pay a lot less for something today if I really believe that that's what the future holds.
Right. If you really believe that, then the terminal, if we're at a 7% cap now for hotels, which some people report from recent transactions, you would logically put in somewhere around a 9.5 or 10% cap rate as a terminal rate, and that's going to severely depress the terminal value, which is discounted back. Those terminal values constitute about 50% of the overall present value.
But what's interesting, maybe it's coincidental, maybe not, you'll know, but if it's 7 today and we add 300 basis points to it, that gets us to 10. And from your research, if my memory is right, that's pretty close to what a long-run average terminal cap rate would be. That's right at
long-run average.
So does that suggest prudent underwriting today would indicate, that's the kind of exit cap rate you probably ought to be contemplating as you're underwriting your deal?
That's probably the theoretically correct way to go, although the convention in the industry is to do something different, and that's either keep the cap rate going in and going out the same, or add something like 50 basis points to the current cap rate. that may not be the correct way to do things at this point in time, and certainly being conservative, you would use a long run average cap rate.
Jack, let me approach this maybe a little bit differently. Looking at investor behavior today, does it appear that the market is valuing hotel investments as a stock or more as a bond?
Well, it seems from looking at the recent NCREIF data on the composition of the total return, where about 7% of the 8% is income and roughly 1% is appreciation, that hotel investments look like a bond today, more so than a stock.
Which is obviously very, very atypical.
Yes, atypical.
Now, to use a term that we've been hearing a lot over the past week or so, is that a lot of malarkey, Jack, or is that something we should buy into?
I don't know what malarkey means exactly.
Well, you're
but,
Irish, so.
The Saturday Night Live interpretation was that it's Irish, and that I would come over and wipe that smile off your face using a true Irish approach.
On that happy note, we wish you the best of luck as the balance of 2012 plays out. Our next edition will be obviously post-election, so we'll see what the landscape looks like then. But again, thanks for taking your time.
Yeah, thank you.